I'm going to talk for a little bit now about private placement investments, specifically real estate investment trusts. One nice thing about working for an independent broker-dealer is you have a whole wide universe of different types of investments and different types of platforms to choose from. Hopefully by now you've already saw the segments about stocks and bonds and mutual funds and annuities. Private placements are a very unique type of investment that can be very specific. You can buy into investments that work with natural gas, equipment leasing, oil drilling, and in this case, real estate investment trusts. Our firm has a policy that the only type of private placement investment we use is real estate investment trusts. And we only use real estate investment trusts if it's approved by your sales manager. Real estate investment trusts can be very risky. However, they can also create some very nice returns for your clients as well. Whenever there's the prospect of higher returns, there's also the prospect of higher risk. Understanding how these products work and the risks associated with them will be very important. First thing I want you to understand is any investor who goes into a REIT needs to be an accredited investor. Now, the definition of accredited investor could change at any time, so I'm not going to tell you what that means in this video, but talk to your compliance officer and they can tell you what the standards are for accredited investor. Our firm has a policy on REITs that goes above the requirement of being an accredited investor. That policy can also change, and I want to make sure you're familiar with that as well. Once again, talk to your compliance officer or your sales manager about the firm's specific policy. Very, very important. Real estate investment trust, as you can imagine, invests in real estate. In a nutshell, how this works is, imagine out there in the universe there are hundreds and thousands of people who would like to own some commercial real estate. Now, none of these people on their own can buy an office building, a big multi-tenant shopping complex, a big multi-family residential apartment building. You know, we're talking properties that are oftentimes $10, $20, $30 million. Just like a mutual fund pools money together to diversify amongst different stocks and bonds, a real estate investment trust, a REIT, pools money from investors. The REIT uses that money and buys investment real estate. The tenants in that real estate pay rent. The rent generates a dividend back to the shareholders. Over time, that dividend should increase as rents increase, and over time, the value of that portfolio should increase as well as the underlying real estate holdings appreciate. So, in general, the model looks something like this. Let's pretend that this particular REIT focuses only on office properties. Some REITs get very specific. They're just going to be single tenant, triple net lease, standalone properties. Some will be office, some will be retail, some will be industrial warehouses, some will be a combination of all those different pieces. But for sake of simplicity, for this example, let's assume that we're only working with a REIT that invests in office property. So all these investors are going to funnel money into the REIT. This is really the private offering. This REIT is not available to the mass public. Now, anyone technically can buy into it, but they have to be an accredited investor. So not everyone can get into it, but everyone's eligible for it as long as they're accredited. So all these dollars flow into the REIT. The managers of the REIT are buying all sorts of different investment properties. So these are all different high-rise buildings located all over the world. There's dozens, if not hundreds, of different skyscrapers, office buildings inside this portfolio. Some of these buildings might have cost $10 million. Some of these buildings might have cost $30 million, etc. Now, the REIT is not necessarily paying cash for these buildings. They can take out loans to buy these buildings just like you can take out loans to buy a house. They're obviously putting some money down, but in general, they're leveraging the portfolio. A typical real estate investment trust is going to raise anywhere from $1 billion to $2 billion of cash from investors. With that $1 to $2 billion, they're probably going to buy $2 billion to $4 billion worth of real estate. That would be the equivalent of putting 50% down on your house. Let's say you had $100,000. You put $50,000 down on one property, $50,000 down on another. Let's say each of those properties is worth $100,000. Well, you own $200,000 of property, even though you only put $100,000 in. So even though they might have this much cash, they're actually going to buy about double the amount of real estate because they're going to take some leverage out. They're going to take some loans out. All the tenants in these buildings pay rent, just like any other rental type of relationship. That rent generates a dividend that goes back to the investors. So there's cash flow. Most real estate investment trusts will yield anywhere from 5 to 7%. Now you ask yourself, well, how does the REIT make money? Well, whenever they buy property, they're brokering a transaction. So they're getting a transaction fee every time they buy the real estate. They're also getting a piece of the rent that's collected, and they're getting an overall management fee sometimes, depending on the REIT, based on how much real estate they oversee, what the value of that real estate is. The overall goal of this particular type of investment is to raise money from investors, buy property, package it all up under one umbrella, pay a nice dividend out to investors, but eventually the goal is to sell this portfolio of real estate. It can be sold via an IPO to the stock market. It could be sold to an endowment or a pension fund, for example, or any combination of that. So the goal is to raise money from investors. So imagine raising $2 billion. You buy $4 billion worth of property because you use some leverage, and you sell the portfolio for $6 billion down the road. If you're a pension fund and you need cash flow for your pension, for your fund, rent from real estate is a powerful form of cash flow. But if you're a pension fund, you don't have the time or the expertise or the desire to use your pension money and go find 200 different office properties that you're going to buy and strike deals with and operate and manage and all that stuff. Rather, what you're going to do is you're going to go to a REIT and say, hey, I really love that you've got these 200 properties pre-packaged, all in one place, all under one umbrella. That way I can just write you a check for all these buildings, have you guys manage it, and it saves the pension company a ton of time and effort and money. Just write one check, buy the whole REIT all at once. Pension funds and the marketplace, the stock market, is willing to pay a premium oftentimes for having all this real estate pre-packaged to be able to buy all in one fell swoop. So that's how the price can go from 2 to 4 to 6 as an extreme example, and how value can be created by packaging this real estate for the marketplace, loading up the portfolio with solid credit-worthy tenants with strong rent histories in good locations. That's what makes the real estate so powerful. Now, with that said, let's talk about some of the risks. If you're investing in office property and our economy goes into a recession like we did in 2008 and 2009, then you're going to lose tenants because some of the companies renting out some of your space could go out of business or downsize. If you're losing tenants, you're creating vacancy in your portfolio, and vacancy means you're collecting less rent, and less rent means there's less cash flow, and with less cash flow for your investors, they're not going to pay as much for it. So as vacancy goes up, value of that REIT goes down. Also, let's say that this particular property right here, whatever that property is, let's say that that's located in Dallas. Let's say the building is 100% occupied. It's a great building, great location, but one block down, there's an office building of similar size, similar amenities. It's not in the REIT. It's off the books, but it's in the same location. And all of a sudden, this building gets foreclosed on because the owner has a lot of vacancy and can't make the payment anymore. Well, all of a sudden, this building gets liquidated at foreclosure at a reduced price. Let's say you bought this building in Dallas for $20 million, and all of a sudden, this building that's not even in your portfolio sells for $8 million. Well, just like residential real estate, this is considered a comparable building relative to your portfolio. So now all of a sudden, by definition, this property is now worth $8 million in your portfolio as well, because the available comp in the same market just went for $8 million. So it's not worth 20. So now all of a sudden, the value of the REIT has not only gone down in value because of vacancies, it also goes down in value because comparable buildings in your same area are going down in value too. Real estate investment trusts have a net asset value, an NAV, just like a mutual fund does. They take the net asset value of all your underlying holdings. Oftentimes the net asset value is $10 per share. But if comparable properties are going down in value, or you're increasing your vacancy and reducing your cash flow, then your NAV can change. We've had products here, unfortunately, that clients got into at $10 and they repriced all the way down in the $4 range because they bought in at the wrong time. That's just bad luck, and you can't always help the timing of it. But it shows just how risky these can be at certain times. It's very, very important whenever you're going to recommend a real estate investment trust to a client that you get approval from your sales manager. We will very, very, very rarely ever put money into a REIT that represents more than a 5 or 10% allocation of someone's liquid money, liquid net worth. And again, that's only for accredited investors. We have a policy here that goes way above and beyond accredited, and there's limits to how much we will let you put into a REIT, just because there is significant risk given the fact that it's not a liquid investment. I didn't say that yet, but you need to know it's not liquid. It doesn't become liquid until it goes public or they sell the fund to like an endowment or a pension fund. So you can end up with clients who get stuck in the fund, they can't get out of it, their NAV is falling, the cash flow is dropping, it can really be a bad situation. That's why you have to use it very, very, very cautiously. With that said, make sure you do some reading on REITs, talk to some wholesalers, talk to your manager, get educated on it. There were a lot of REITs sold over the last 10 years by a lot of advisors. You're going to run into a lot of clients who have REITs, even if you don't recommend them. You'll run into clients who have them, and you're going to want to be able to explain the concept and be educated on the concept yourself.